Well, the ADP report that came out today was 3 times bigger than expected. It caught everybody off guard. Keep in mind the dollar strengthened yesterday. Some people were put at ease, so gold fell $40 yesterday. It's off again today a little bit. It seems like people are getting used to the fact that, hey, maybe our economic data is better than expected. Maybe the economy is going to expand in 2011. Gold's not the safe haven. People are going to dump it. That's what I said before. Gold might be a good trade, but it's going to have a lot of volatility in it. I'd be really nervous to hold on to it.
If you hold on to it, though, say for a year, you know, the Barbarous Relic's up 23% in that time so far. That's been a great return on your investment.
You're right. And the thing is, gold, a lot of people think it should be a meaningful part of your investment allocation to keep a balanced portfolio. I'm just saying, as a trader, if you're just going to be long gold, just expect a lot of volatility. If our housing data gets better, if our economic data overall continues to get better and QE2 starts to dwindle, not mean as much, gold's going to fall out of bed, because at the end of the day, it doesn't have much commercial use. It's just something that's driven by fear.
Are you surprised, though, that copper, you talked about the housing link, that's another commodity that's just started to unravel a little bit. That's coming in spite of that jobs report. Now, if you believe the follow-through on jobs equals, you know, a greater appetite for housing, that fall is a little hard to understand.
Yeah, I agree. It is a little hard to understand, but it goes back to the basic premise that in commodities markets right now, I would go after something that's driven by scarcity, not by momentum. And what I mean by that is that you have oil and copper. There's scarcity of it. World demand is very, very big right now, and you can't ration demand. On the other hand, you have coffee and sugar that's driven more by momentum. So if, as a trader, if you want to be involved in something driven by scarcity, I would just keep buying copper or hold on to it.
Therefore, when it comes to the softs, can you distinguish, you mentioned your coffee, your corn, which of those is least susceptible to being part of that sell-off when it starts to happen, as we're seeing now?
I would have to say copper, only because the world demand for it, given the emerging markets demand for copper right now, I can't see. I think that's the safest commodity. Yeah, will it have volatility? Of course. It's had a huge run-up, up 20% or something in the last quarter. But compared to something like silver that was up 40%, silver doesn't have the same luster that copper has in the worldwide demand. So I think copper's where it's at right now.
Let's talk about the crude price itself and then the link with some of the energy companies. It's interesting, Chevron touched a 52-week high. It was like that was a ceiling and it fell from that perch. But you got ExxonMobil overnight. As crude actually kind of reversed, it touched a 52-week high. What's going on?
Very interesting. Oil remains kind of flattish today, even with bullish economic factors coming out with inventories. The fact of the matter is oil is going to climb. It's going to test that $100 a barrel and even go higher than that with world demand. It's going to have one of those things where it's going to rally $10, drop $5, and it's going to hit that spot where the U.S. consumer is going to start realizing, like, we can't afford to buy gasoline for our cars anymore. And that could be an outlier that could cause problems in the second half of next year. But it's clear from all the fundamentals and from the volatility in the options market that people think oil will hit $100 a barrel. Whether it remains there all year is a different story, but it definitely is going to test that in the next 3 months.
When does that fall in demand kick in from your view, Larry? Some say it's more towards the $4 a gallon mark at the pump. What are you hearing?
For me, $4 a gallon. But I think what I just read a couple days ago, they're thinking $4.50 a gallon is what's going to cause a break in the economy to the point where people will have to make sacrifices to drive to work or take public transportation, things that most of the world does anyway. But the United States is such a car-driven economy. $4.50 a gallon seems to be the beginning of the breaking point. And that's something that we saw, at least in Illinois, in the beginning of '09.
Did you read much into that MasterCard Spending Pulse report? Now, I know there was a lot that contributed to that worst fall in 5 years now. Demand at the pump off already. Not waiting for it to happen, but it's already fallen 13%. That's the lowest level since Hurricane Katrina. But I know you've had bad weather. I know there have been other factors, but put that into context.
Yeah, we do have, we've had some awful weather, especially along the eastern seaboard, which is a little bit more moderate than Chicago and the Midwest. But it seems like it's been more inventory related and also fundamentally driven from traders on the floor that I've talked to. When you look at options premiums, it's suggesting that the inventories are going to lag and that therefore you're going to see price spikes probably a little bit greater than they need to be. We're going to see a lot of volatility. Like I said, $100 a barrel, no question about it, but will it remain there all year? There's a lot of moving parts going on in the market, but it seems like the options markets in oil are suggesting a short-term rally to $100 a barrel.
And maybe at the start of the summer driving season, you could expect and anticipate a ramping up in consumer demand. It'll just inevitably swing back. Is that on the cards?
It definitely is, but the fact of the matter is, putting gas in your auto is just one piece of the puzzle, as you know. I mean, everything will go up in price, and one thing that the Fed does not want to happen, we don't want to see a massive amount of inflation with all the QE2 buying going on in our economy. We can't afford inflation. Right now, our inflation rate's as low as it's been since 1958, but gasoline going up to $4.50, $4.75 a gallon will spark inflation, and that could spell doom for our markets for the second half of 2011.